Hi folks, welcome to this video on transaction analysis. You may recall from your reading in the chapter that we perform transaction analysis so that we can determine the effect that each financial transaction in a company has on the balance sheet equation. And you'll remember the balance sheet equation was assets equals liabilities plus shareholders' equity. Now, just to refresh your memories, what does this balance sheet equation really mean? The balance sheet equation really represents all of the things that we own. And what can we do with those things? With everything we own, we pay our debts, and if we have any excess left over, it's savings or equity. So generally speaking, anything that we don't spend in our assets is saved as equity in the business. So all of our assets are either saved or they're spent to pay down debts. So with that in mind, let's make sure that for each financial transaction that we're going to come across in this question, that it allows the balance sheet equation, assets equals liabilities plus shareholders' equity, to stay in balance. Because if it doesn't, one thing I can tell you for sure is if it's not in balance, it's highly unlikely that you're going to get a balance sheet that balances. So now let's begin. Let's look at the first transaction. So we're dealing with a company, A.J. Smith, and if you haven't got your textbook with you or you haven't printed the problem, I would suggest that you do that just so that you can follow along. So now the first first of all, it says that A.J. Smith started their business on January the 1st of the year, the current year, and they have some transactions that happened. On the date they began business, it says that they issued 12,000 common shares at $25 a share. Well, the reason why they would be issuing those shares to investors is because they're trying to raise enough capital to run their business, right? So in that case, what would we do? Well, first of all, the investors gave A.J. Smith money. That's what they got. They got shares, and in return, they gave A.J. Smith money. So we're analyzing these transactions from the perspective of A.J. Smith. So A.J. Smith's cash just increased. I'll just put a little INC in here so you understand that that's for increased. So because cash increased, and cash is an asset, assets increased. What else happened? There was no other asset that was affected. Now, you might be saying, how do you know that I have to have columns for all these assets? Well, to be honest, you don't really know that when you're starting, right? But what you do know is that if you're doing this in Excel or Word, you should, if you're setting up a table or you're using Excel, you should make sure that you have enough columns set up so that you can put in account names as you need them. So we know that a liability is not affected here. Why? Because the company is issuing shares, and shares are equity. You remember from chapter 1, they said that's equity, right? So I'm going to go into the shareholders equity section, and I'm going to create an account name for common shares. And I know because shares were issued, they are now sitting with shareholders. So the total dollar value of the common shares that are issued and sitting with shareholders increases. 300,000. How do I get 300,000? I took the number of shares we issued at 12,000 and multiplied it by $25 a share, because that's what they paid me to get those shares. So what do I know? I know my shareholders equity increased because common shares is a shareholders equity account, and it increased. I also know that cash increased, and cash is an asset, so my assets increased. So the accounting equation is in balance because the left-hand side of the equal sign, which is my assets, went up by 300,000, and the right-hand side of the equal sign, shareholders equity, also went up by 300,000 because common shares went up by 300,000. So my accounting equation is in balance. So now let's go look at the next equation. Well, what do we have here? In fact, when you're submitting your assignment, you don't have to put decrease and increase in. You can, but I just kind of use that to help you analyze the transaction so you know the net effect it's having on the balance sheet equation. So I kind of like to put these in as I go. So let me just take them out for now, and then we'll put them in. Now, this question said that A.J. Smith bought land in a building. First thing you need to realize is that whenever you have a purchase of both land in a building or land and equipment, or land and vehicles, whatever it is, or even building and vehicles, building and equipment, you need to separate out those two assets as separate assets. Why? Because in the case of land in a building, land is depreciated, land is not depreciated, and a building is. If you bought a building and equipment, they're both depreciated, but they might be depreciated differently. And we're going to talk a little bit more about depreciation, but just know that in this case, because land is not depreciated and a building is depreciated, we separate them out. So the question is giving you enough information to help you separate them out. So let's go have a look at what they gave us. They told us that the total value of the transaction for that land and building purchase was $230,000. How do I know this? Because the question told me that to get that land and building, A.J. Smith had to give $80,000 in cash, which is here, and they also had to issue the seller, the company from which they bought that land and building, they had to give them 6,000 shares. We know the value of the shares was $25 a share because this transaction for buying the land and building is happening at the same day that we issued the shares. So we know the shares are trading at $25 on the same day. So this is $150,000 in the bracket. So 150 plus 80 is going to give us $230,000. So how do we separate that $230,000 between land and building? Easy. Question told you that the land was worth 25% of the transaction. So 25% of $230,000 is $57,500. So the building has to be the difference between the total value of the transaction and the value that the land is worth. So we're going to set the building up at $172,500. So if we go back to our transaction analysis template, we have the land set up at $157,500. The building set up at $172,500, and of course, because the land is increasing, our assets are increasing, and because the building is increasing, what did I do there? Let me see. Because the building is increasing by, we said, $72,500, then that means $172,500. That means assets are also increasing by $172,500. So you have your assets increasing because you bought land and building by $230,000, but you've also used up an asset, which is cash, and cash is going to be decreasing, and because cash is an asset and it's decreasing, it also decreases your assets. So if we net out on the asset side, the net effect here, we have a net increase in our assets of $150,000. So on the right-hand side of the equation, do we have a net increase on liabilities and equities? Well, sure we do. Nothing's happening with the liability piece, but we did issue $150,000 in shares, 6,000 shares times $25 a share. So that comes out to $150,000 in common shares. That account is increased, so that means that shareholders' equity is increased. So we have assets on the left-hand side of the equal sign at net going up by $150,000, and liabilities plus equity, specifically here shareholders' equity, going up $150,000 because common shares, the account common shares, which is an example of shareholders' equity, it went up $150,000. So the accounting equation is in balance. Left-hand side of the equality goes up $150,000. Right-hand side of the equality goes up $150,000. And we're good. Now, let's have a look at what happens in this next transaction. The next one is tricky. A.J. Smith decides to rent out part of its building to Frantech. Frantech gives them payments every quarter up front for rent. You know, if you've ever rented anything, if you've ever rented an apartment or a house or whatever, you always pay in advance, right? So what's happened? All they're saying is that Frantech gave A.J. Smith $7,500 on March the 30th. That March the 30th payment that A.J. Smith got is going to provide Frantech with tenancy from April, so through April, May, and June. Right? So it's going to be providing them tenancy from April the 1st to June the 30th. The June 30th payment is going to, that A.J. Smith gets, is going to provide Frantech tenancy when? For May, the June payment is going to provide tenancy for July, August, and September. So you can see that Frantech is always paying in advance for its tenancy in A.J. Smith's building. So what does that mean? By the time we get to the end to A.J. Smith, what it means is that by the time we get to the end of December, they got 4 payments of $7,500. So that means that their cash is increasing by $30,000, and cash is an asset. When the asset increases, when the cash increases, the assets increase. So we have assets increasing by $30,000. No other assets are affected, so let's look at the liability and equity side. Now, I'm proposing to you that unearned revenue is going up or increasing by $7,500. So let's review what an unearned revenue is, because we talked about this in the first chapter. Unearned revenue is a liability. Why? This is the $7,500 payment that A.J. Smith got from Frantech at December 30th. Why is it a liability? Because A.J. Smith is being paid in advance of offering Frantech tenancy, because that $7,500 payment is providing tenancy for Frantech in 2017, which is the next year. So it's providing tenancy from January the 1st. Okay, so it's providing January, February, and March, so to March the 30th of 2017. So it's providing 3 months tenancy into 2017. Well, guess what? We're in 2016. So we know that the $7,500 that A.J. Smith got from Frantech is basically, to them, money that they're getting in advance, them being A.J. Smith, but they haven't provided any service yet. So that, to them, money received in advance for services that you don't yet provide, it's an unearned revenue. So that represents the $7,500 that they got at December 31st. That to A.J. Smith is an unearned revenue because they haven't provided tenancy for it yet. So what's going to happen? I got a liability here, but I got to have the right-hand side going up by $30,000. So far it's only going up by $7,500. Well, I'm proposing to you that your retained earnings is going to go up by $22,500. Why is that? By $22,500. That represents the first 3 payments in the first 3 quarters of 2016. Why? Because the March payment provided tenancy for April, May, and June. The June 30th payment provided tenancy for July, August, and September, and the September 30th payment provided Frantech with tenancy for October, November, and December. So those 3 payments of $7,500 each, or $22,500, A.J. Smith has technically earned them. Why do I say they've earned them? Because when they got the money, the year that they got the cash, they also provided the tenancy. So the money that they got has been earned. That, by definition, is revenue. And what you learned in Chapter 1 is that when you book revenue, you increase income. And income, when income increases, retained earnings increases. So you may remember from your Chapter 1, I don't know if this is a little bit, I don't know how well it's coming across on your side, but you might remember this graphic from that chapter. What it said is that whenever you have revenue, that will increase net income. Expenses will decrease income. So your net income is increased by revenues and decreased by expenses. These revenues are increasing net income. Any net income, when added to the opening balance of retained earnings, right, is going to give us ending retained earnings. We haven't had any dividends here yet, but just wait, we do. But in any case, whenever you earn income, it increases retained earnings. So all I'm saying is that because we've earned revenue, we've increased income. When we've increased income, we've increased retained earnings. Retained earnings is a shareholders' equity account. So when it goes up, when retained earnings goes up, shareholders' equity goes up. The little r here means that this $22,500 is going to represent revenue. Right? So this represents revenue. You'll notice here the R represents revenue, the E represents expense, and the DD represents dividends declared. Each of these 3 accounts have an impact on shareholders' equity through this graphic. So this I just copied and pasted from your Chapter 1. So what it means is that revenues increase net income, expenses decrease net income. So at net, your net income, if revenues exceed expenses, net income will increase retained earnings. Any dividends that are declared reduce retained earnings. But we only have revenue in our question so far. So you can see here that because your revenue increases, that increases retained earnings. And because retained earnings increases, shareholders' equity increases. So on the right-hand side here, we have an increase of 30,000, and on the left-hand side of the equal sign, an increase of 30,000. So the accounting equation is in balance. Now what do they tell you? In this transaction coming up now, in number 4, they tell you that A.J. Smith went out and bought equipment. How did they pay for it? They used $60,000 cash, and then they also issued a note payable. Notes are different than accounts payable in the sense that notes payable, they're a little more strongly enforceable. So they're like promissory notes. I don't know if you remember this discussion from earlier on in the textbook, but they did, I believe, discuss notes. And notes are basically promissory in nature, or they might have even discussed them in chapter 2, but the idea is that they're promissory. So that means that there's a stronger commitment behind it. It's more of a legal contract or a document. So this company said, well, we're not just going to merely take your promise to pay, we're going to legalize it or enforce it a little bit more. So we're going to make you sign a note. So what does that mean? While A.J. Smith has an asset that's increased, which is the equipment, that equipment is an asset, and so assets have increased by $120,000. But you also have an asset that's decreased, and that's your cash. So at net, you have your assets going up by $60,000, but you also have your liabilities, which is your promissory note or note payable, going up by $60,000. So now your liabilities have increased. So you can see on the left-hand side of the equation, liabilities and equity, specifically liabilities went up. Why? Because your note payable went up. A note payable is a liability. When that liability, the notes payable goes up, because it's a liability, your liabilities increase. Here you have a net increase in assets of 60,000. So when the assets go up by 60,000 and liabilities go up by 60,000, the accounting equation is in balance. Now what do we have? Transaction 5. It says here that we had inventory costing $250,000 and it was purchased on account. So now what does that give us? Well, it says here that if we bought this inventory, all right, then our inventory is going up. Inventory is an asset. It's product that you buy to resell. So your inventory is an asset. You're buying inventory. You're going to resell it. It's an asset. So that means because your inventory is going up and it's an asset, your assets are going up. But you're buying them on credit. So normally, anybody who supplies you with inventory that you're going to sell is an account payable. So your accounts payable, that's a liability because it's something that you owe somebody, right? So think of liabilities as something you owe somebody and assets of something as something you own. So that's kind of the difference. So what have you got here? You've got assets going up because inventory is going up. You got liabilities going up because accounts payables going up. On opposite sides of the equal sign, so that means the accounting equation is still in balance. Let's now look at transaction number 6. This looks a little bit different. Now it's telling you that sales were $300,000, but $250,000 of them were credit sales. So how does this affect your accounting equation? Well, if you sold $300,000 worth of stuff, right? Or I should say you made sales of $300,000. That's revenue. That's sales revenue, right? So you know that because you've sold, you know that your sales revenue is going up. So we've got an R in here. And whenever your sales revenue goes up, what does that mean? That means your retained earnings goes up. And again, that means that shareholders' equity goes up. So we know that. What else do we know? Nothing else has happened on the liability side, but what do we know? We know of that $300,000 in sales revenue that we booked, $250,000 of it was on account. So we sold to customers on credit. Our customers to whom we sell on credit represent accounts receivable. Why? Our customers are accounts from whom we're waiting to receive money, hence the name accounts receivable. So receivables are for customers, right? Payables are for suppliers. We owe suppliers money, so we have something that we have to pay to them, so it's a payable. Customers, we're waiting to receive money from because we sold to them on credit, so it's a receivable. And your receivables have gone up. And because you own title to that money from your customers, so you're owed the money from your customers, they have to pay you. They're supposed to pay you. So it's a receivable, it's an asset, and that's gone up. But don't forget, not everybody sold to you on account. Some people gave you cold hard cash, so your cash goes up. So you can see that your two assets, receivables and cash, have gone up. So your assets have gone up $300,000. Your equity has gone up $300,000. So therefore the accounting equation on both sides of the equal sign, assets go up by 300, shareholders equity goes up by 300 because revenue went up by 300. When revenue goes up by 300,000, so too does retained earnings. We talked about that when we talked about this little graphic here. Right? So we have the accounting equation is still in balance. So now, let's go to transaction number 7. Now it says here that the inventory that we bought, you remember in item number 5, we bought some inventory here, $250,000 of it. The inventory that we bought and we subsequently sold here in transaction 6, that inventory cost us $190,000 to buy. So the idea here is that when you make the sale, the inventory leaves the building, right? So when the inventory leaves, what happens? Your inventory is going down. So you notice it's got a bracket here, and that means, again, your inventory is decreasing, and inventory is an asset. When it decreases, assets decrease. But nothing happened in the liability side, but let's go moseying over onto the shareholders equity side. What happened here? Well, in this case, what we've got is we've got an expense going up. What's our expense? The expense that we would have impacted here would be what we call the cost of goods sold. And I'm not sure if you remember that account from chapter 1, but if you go back to chapter 1, the cost of goods sold represents the value of the inventory that you bought at your cost that you've now sold. So the cost of goods sold, it's just as it sounds. It's the cost of the goods you sold. Because when you make a sale, the inventory leaves, right? So we have to reflect the fact that the inventory is no longer here. In this case, doing that makes us increase in expense. Cost of goods sold is an expense because you paid to get your inventory, right? So it was a cost to you. So when we sell it, we release the inventory that we bought to the income statement as cost of goods sold. So our cost of goods sold is an expense and it goes up. Now bear in mind that when an expense goes up, what did we say here? When an expense goes up, it's partly going to reduce income, right? And it reduces retained earnings. So from a separate perspective, when we separate out revenues and expenses, whenever we have an expense or we book an expense or a cost of doing business, it reduces our retained earnings. So we're decreasing retained earnings, and when we decrease retained earnings, we decrease our shareholders' equity. So what does that mean? Assets are decreasing by $190,000 because inventory was sold, and inventory is an asset. And shareholders' equity is decreasing by $190,000 because retained earnings decreased. And retained earnings decreased because our expenses went up. So notice the trend. Expenses go up, retained earnings goes down, shareholders' equity goes down. Revenues are a source of income. They go up. That means that your retained earnings goes up and shareholders' equity goes up. In our case, what we have here is assets decreasing $190, shareholders' equity decreasing $190. So the equation on both sides of the equal sign are affected by the same amount and in the same direction, so the equation is still in balance. So now what I'm going to do is I'm going to give you guys a little short break the video up a bit because it's probably gone on for about 20 minutes, and then I'm going to come back with part 2 and finish off the transaction analysis for you. So get yourself a drink, right? Something to eat, And we'll be back momentarily.